Cisco jumped 17% in just 3 trading days, and the headline sounds exactly like what the market wants right now. AI infrastructure orders, strong guidance, and a mature tech company suddenly getting re-rated. But here is the question for investors watching the move after it already happened. Is Cisco still a buy after this jump, or did the market just price in too much good news? This is not financial advice, it is a FinanceToGo research breakdown. And if you want a clear stock reviews that separate headlines from valuation, subscribe to FinanceToGo. So, what exactly happened? Here's what happened. Cisco reported Q3 fiscal 2026 results after the close on May 13th. Revenue came in at $15.8 billion, up 12% year over year. Non-GAAP EPS was $1.06, up 10%. The stock then closed at $115.53 on May 14, up more than 13% in one day and about 17% over the 3-day screen. The big reason was not just the earnings beat, it was the AI infrastructure reset. Cisco raised expected fiscal 2026 hyperscaler AI infrastructure orders to $9 billion, up from the prior $5 billion expectation, and raised expected AI infrastructure revenue to $4 billion. So, what does the company do? Cisco is not a pure AI chip company. It sells the infrastructure that connects and protects networks, switches, routers, campus networking, data center networking, security, collaboration software, observability, and services. That matters because AI data centers are not just GPUs. They also need networking capacity, secure infrastructure, and systems that can move huge amounts of data reliably. The headline is simple. Cisco jumped because AI infrastructure demand looks stronger than investors expected. The reality is a little more nuanced. The quarter was genuinely good. Product orders rose 35%. Networking product orders grew more than 50%. Q4 revenue guidance was $16.7 to $16.9 billion, and fiscal 2026 revenue guidance moved to $62.8 to $63 billion. But the valuation question is just as important. After the move, Cisco trades at around 27 times the midpoint of fiscal 2026 non-GAAP EPS guidance. So, did the numbers justify the move? The numbers justified a positive reaction. Revenue grew 12%, non-GAAP EPS grew 10%, total product orders rose 35%, networking orders rose more than 50%, and the AI infrastructure order expectation moved sharply higher. That is the good side. The weaker side is that GAAP gross margin and non-GAAP gross margin both fell year over year. Security revenue was flat. Collaboration declined 1%. Operating cash flow was $3.8 billion, down 7% from the prior year. So the quarter was strong, but it was not perfect. On the price chart, this was a fast re-rating. Cisco went from $98.72 before the move to $115.53 after the move, using about 4 billion diluted shares that added roughly $67 billion of market value. That is the key point. The market did not just reward Cisco for a good quarter, it repriced Cisco as a better AI infrastructure story. For valuation, I would use a fair value range around $90 to $105, and a more interesting buy zone discussion below roughly $85 to $95. At the current post-move price at around $115, the stock is way above that range. The market is assuming AI orders convert into revenue, margins stabilize, networking demand stays strong, and Cisco deserves a higher multiple than its old mature networking profile. So, is it a buy after the move? For FinanceToGo's post-move rating, Cisco lands as a sell after the jump. Not a strong sell because the business did improve and the catalyst is real, but it is a sell because the stock moved faster than the fundamentals. A good quarter does not automatically make the stock a good buy at any price. I would get more interested on a pullback toward the $85 to $95 area, or if Cisco proves that AI infrastructure orders are converting into revenue without margin pressure. So what to watch next? Here's what to watch next in Q4 revenue versus the $16.7 to $16.9 billion guide. AI infrastructure orders tracking towards $9 billion. AI revenue tracking toward $4 billion, gross margin stabilization, security returning to growth, and operating cash flow recovering. The simple takeaway is this: Cisco's AI story got stronger, but the stock already paid for a lot of it. Tell me in the comments, was this 17% move justified or did the market overreact? And subscribe to FinanceToGo for more big mover breakdowns. Again, this is educational content only, not financial advice.